The inventory turnover ratio is calculated as the ratio between sales and inventories. That means inventory turnover ratio is equals to sales divided by inventories. So when we get the inventory turnover ratio 30.36, what does it mean? How can we interpret this result? In fact, we can say that on an average for this company, the inventories turnover 30.36 times in a year. So you can understand that the more frequent the inventories turnover, the better it is for the company, because the company can complete more and more business cycle throughout the year. For example, if the inventory turnover ratio is 50 instead in place of 30, then we can say the company has completed 50 cycles of processing inventory during the year, which is very good, because the company effectively has done more business when its ITO is 50 than when its ITO is 30. Now, to compare, if we want to look at the relative performance relative to another company or maybe industry benchmark, we can of course compare the current inventory turnover ratio with that of the competitor or a benchmark company or the industry average inventory turnover ratio. That is that can help us to see the current position of our company relative to our benchmark. Now what about the time series comparison? That means comparing over time. Okay, we can look at the time series comparison for at least 2 years here, because we have the calculation results for 2017 and also 2018. In fact, we can actually insert a chart from the Excel tool, okay, and use the chart to see the inventory turnover ratio changes over time. In fact, for comparing only 2 years performance doesn't need a chart, but if we compare over 5 years or so, then we will of course use the chart, because that will be more useful. So to draw the chart, we have to select the series. Before that, we have to give a name of the series, that is inventory turnover ratio. You can write in full as well. So the series names should be selected. So series values should be selected. So we are selecting it here. You can already see that. But one thing is remaining. We have to place the year in the series title. Okay, so those are in fact in cell G3 and H3. So we have selected that, and you can see that the chart is clearly showing the inventory turnover ratio comparison between the years 2017 and 2018. So from this comparison, we can clearly identify that our inventory turnover ratio has increased in 2018 compared to what it was in 2017, from 28 to 30. That is a very good sign, because we are turning over inventory more times during the year, and that clearly indicates that our inventory management performance is getting improved over time.